Hello, hi dear students. In this video, I will try to take you through few important concepts under Ind AS 115 and also try to take you through few important examples that would be relevant for your exams. So first we'll see how the contract cost is defined under Ind AS 115. So under Ind AS 115, contract cost can be classified into two categories. One, its cost to obtain a contract, and second, cost to fulfill a contract. Okay, within cost to obtain a contract, we can have two types of accounting treatment. If it is incremental cost, then this can be capitalized. If it is not an incremental cost or if it is a routine nature, then it should be charged to P&L. Similarly, under cost to fulfill a contract, we can recognize this as an asset if certain conditions are met. If those conditions are not met, then it should be charged to P&L. So this is how we are going to see in detail. Okay, so first on the cost to obtain a contract, let's see what are the conditions that needs to be met in order to qualify to capitalize those costs. Okay, so I have given those conditions here. So conditions to qualify to capitalize as cost to obtain a contract. Right, so all the below conditions should be met in order to capitalize those costs. So the first condition is that the cost should be incremental. So meaning these costs would not have been incurred had the contract has not been entered into. Okay, clear? So there should be one-on-one correlation between the cost incurred and the contract. So in that case, it can be qualified to capitalize as a contract asset. And second condition is that the cost should be recovered from the customer. Okay, so let's see if these conditions are not met, then it should be charged to P&L account. So we'll see a few examples. So you can take legal fee. Okay, so legal fee can be an incremental cost or it can also be a regular cost. So if legal fees are incurred in order to for the specific contract, and if these legal fees would not be required if the contract is not entered, so if that be the situation, then it can be capitalized. But if these legal fees are routine in nature, and even if the contract is not entered into, then if these legal fees will continue to be incurred, then in that case it should be charged to P&L account. Okay, similarly, if you take advertisement expenses, generally it is regular in nature, so you cannot establish one-on-one correlation between advertisement expenses and a specific contract, then in that case it should be charged to P&L. And travel expenses can be interpreted in both the ways. If you have a travel expenses to bag a specific contract, and if those travel expenses would not be incurred if the contract is not getting signed, then in that case it can be capitalized. Otherwise it should be charged to P&L. And sales team salary, generally it is common in nature, so irrespective whether you are entering into a contract or not, then those salaries will have to be incurred. So in that case it should be charged to P&L and cannot be capitalized. And sales commission, so by the nature sales commission will be paid only if you have the contract. If you don't have the contract, sales commission will not be paid. So in that case it can be qualified to be capitalized. Okay, so then coming to cost to fulfill a contract, so in order to capitalize or recognize asset of those costs to fulfill the contract, few conditions needs to be met. So these are the conditions, all these conditions needs to be met. So one, cost should be directly related to the execution of the contract. So there should be one-on-one correlation directly between the execution of the contract and the cost. Okay, the example could be the direct material, direct labor and overheads. And these costs should generate resources that will be used to satisfy the performance obligation of the contract. So these are the costs incurred to satisfy the performance obligation of the contract. And third condition is the entity expects to recover this cost from the customer. Okay, so if all these conditions are met, then it can be recognized as an asset. Otherwise it should be charged to P&L. So as we discussed, the example could be direct labor, direct material, allocated overheads, and any other direct cost all these can be recognized as an asset to fulfill the contract. In other words, the general administration expenses, any abnormal waste and costs related to already satisfied performance obligation, so these all are needs to be charged directly to P&L. Okay, and one more note, as per Ind AS 115 allows to charge off to P&L even though it is incremental cost to obtain a contract if the amortization period is less than 1 year. So generally you will capitalize if the amortization period is more than 1 year. So otherwise it should be charged to P&L even though it is incremental cost. Okay, and one more note on cost to fulfill a contract. So there are some specific accounting standard like Ind AS 16, Ind AS 2. So in that case, those specific Ind AS needs to be followed and not Ind AS 115. For example, if there are any capital expenditure, you have to follow Ind AS 16 guideline. And if there are any inventory related expenses, then it should be dealt as per Ind AS 2. So for the remaining, we can have a reference to Ind AS 115. Okay, so let's also go through few more examples here. So commission, as I told you, it's like a cost to obtain the contract, so this can be capitalized. Travel expenses, it's given that travel expenses for salesperson pitching for a new client, so which means you don't have the firm contract asset, so it should be charged to expense account. Then legal fee for drafting the terms of the arrangement for parties to approve and sign, which means it is not yet approved, so anytime the contract may be cancelled. In that case, it should be charged to P&L. Then salaries for the salespeople working exclusively for obtaining a new client. So it's all sales efforts. You don't have any firm contract as on date, so it should be expensed. And bonus paid on a quarterly sales target. So here one-on-one correlation can be established, so this can be capitalized. Similarly, commission paid to sales manager based on the contracts obtained by the sales manager's local employees. So here also one-on-one correlation can be established, so this can be qualified to be capitalized. Okay, so then we will see few distinction between Ind AS 115 and the accounting standard 7 and accounting standard 9. So Ind AS 115 talks about how to recognize the revenue from contracts, and accounting standard 7 talks about construction contracts, and accounting standard 9 talks about the general revenue recognition. Okay, so from framework of revenue recognition perspective, Ind AS 115 provides a detailed description on how to recognize the revenue and revenue to debit the transfer of the promised goods or service. So this is very detailed guideline available under Ind AS 115. And but accounting standard 9 and accounting standard 9, they do not give any clear guideline to refer to when you are in doubt. Okay, similarly, guidance on how to recognize the multiple element in the contract. Here also under Ind AS 115 we have the detailed guideline, but here under accounting standard 79 there are no such guidelines. And coverage with respect to performance obligation, so it's covered very well under Ind AS 115, but accounting standard covers revenue from construction contracts measured based on the consideration received or receivable. So revenue is recognized based on the consideration received or receivable. So probably there could be link between consideration receivable versus performance obligation, but that is not very well talked under in accounting standard 7. And accounting standard 9 covers only the general revenue from sale of goods and services. Okay, then measurement of revenue perspective at transaction price. Ind AS 115 suggests at transaction price, and accounting standard 7 based on the consideration receivable, and accounting standard 9 based on the charges made to the customer for supply of goods and services. Okay, then guidance to capitalization of cost. So here describes when to capitalize the contract cost to obtain and contract cost to fulfill the contract. So the detailed guideline is available as we just seen in Ind AS 115. But there are accounting standard, no such detailed guideline are available. Then under disclosure requirement, we have detailed disclosure requirement under Ind AS 115. So there are disclosure like specification of revenue and then contract balances. Then what are the performance obligations needs to be specified in the financial statement. Then how the allocation of transaction price to the respective performance obligation is determined, that also needs to be specified. And time duration to complete those performance obligation, that also needs to be specified in the financial statement. And information about significant judgment used in capitalizing the contract or recognizing the revenue, that also needs to be disclosed. And specification with respect to capitalized cost, so all these needs to be disclosed under Ind AS 115. But in the other accounting standard, there are no such disclosure requirements. Okay, then we'll go through few examples which will help you to remember the concepts specified under Ind AS 115. Okay, you can read this first question. So here QTV released an advertisement in Desha Bandhu, a vernacular daily newspaper. So instead of paying for the same, QTV allowed Desha Bandhu a free advertisement spot, which was duly utilized by Desha Bandhu. So how revenue for these non-monetary transactions? So this is non-monetary transactions in the area of advertising will be recognized and measured. So as per Ind AS 115, for all the non-monetary transactions needs to be recognized under fair value. So we'll have to determine what is the fair value of those advertisements. Then based on the fair value, the revenue needs to be recognized both by QTV as well as Deshabandhu newspaper. We'll move to the second example. So here A Limited is a telecommunication company entered into an agreement with B Limited, which is engaged in generation of supply of power. The agreement provides that A Limited will provide 100,000 minutes of talk time to employee of B Limited in exchange of getting power equivalent to 20,000 units. So this is also kind of a non-monetary consideration. So A Limited normally charges 50 paise per minute and B Limited normally charges 2.5 rupees per unit of power. So how should the revenue to be recognized by both of them? Okay, so here also we'll have to take the fair value. So A Limited will recognize this 100,000 minutes of talk time, which is given at 50 paise per minute. So that comes to 50,000. So A Limited can recognize revenue of 50,000 rupees. Similarly, B Limited will recognize this 20,000 units, the value per unit given at 2 rupee 50 paise. So B Limited will also recognize 50,000 rupees as income. Okay, then let's go through the next example. So here company X enter into an agreement on 1st Jan 2021 with the customer for renovation of hospital and install a new air conditioner for total consideration of rupees 50 lakh rupees. So the promised renovation service including the installation of a new air conditioner. So this promised consideration include a new air conditioner is a single performance obligation satisfied over time. Okay, so the total cost is 40 lakh rupees including 10 lakh for air conditioner. So company X determines that it acts as a principal in accordance with paragraph B34 to B38 of Ind AS 115 because it obtains control of the air conditioner before they are transferred to the customer. Okay, so before they are transferred to the customer, the company X obtains the control of air conditioner. So the customer obtains the control of air conditioner when they are delivered to the hospital premise. Okay, Okay, company X uses an input method based on the cost incurred to measure its progress towards complete satisfaction of the performance obligation. So as of 31st March 2021, other costs incurred excluding the air conditioner are given as 6 lakh rupees. So the question is whether company X should include the cost of the air conditioner in measurement of its progress of performance obligation. So how should revenue be recognized for the year ended 31st March 2021? Okay, we'll go through the answer. So some tip. The sale of air conditioner is not the primary business of company X, and hence it should be accounted at 0% margin. Okay, so in this case, company X just buys and provide the air conditioner to the hospital, and it is not their regular business. So company X regular business is to construct the hospital, not to supply the air conditioner. So air conditioner is kind of an add-on service, so that needs to be accounted at 0% margin. Okay, so let's see how this allocation should happen. So given the total cost is 40 lakh rupees and it's allocated between air conditioner, one performance obligation, and other cost as another performance obligation, 10 lakh and 30 lakh respectively. And revenue 50 lakh rupees, out of which air conditioner, since it has to be accounted at 0% margin, so out of 50 lakh, 10 lakh at cost will be allocated for this performance obligation, and remaining revenue will be allocated to the other regular services. So the total margin 10 lakhs comes only from the other regular services and not from air conditioner. So in terms of margin, even though it is 20% margin in overall, but from the regular routine services it is 25% margin. That is 10 lakh and 40 lakh is 25%. And actual cost incurred to date, it's given as 10 lakh for air conditioner, which is already incurred, and 6 lakh out of this 30 lakhs already incurred. So total cost incurred is 16 lakh rupees. So now we'll have to see what is the revenue. Okay, so now for the air conditioner, since it's at 0% margin, so entire revenue at cost 10 lakh can be recognized. And your revenue from other costs will be 8 lakh because you can add 25% margin. So 25% margin on 8 lakh will come to 2 lakh rupees. So 2 plus 6 is 8. So you are allowed to recognize revenue at 8 lakh rupees. So the total revenue to be recognized is this 8 lakh plus 10 lakh will be 18 lakh, and total profit to be recognized is 2 lakh rupees. Okay, we'll go to the next example. So here an entity G Limited enters into contract with customer P Limited for the sale of a machinery for rupees 20 lakh rupees. So P Limited intend to use the said machinery to start a food processing unit. The food processing industry is highly competitive, and P Limited has a very little experience in the said industry. So it's kind of a new industry for which G Limited enters into contract with P Limited to supply a machinery, and the consideration fixed at 20 lakh rupees. And P Limited pays a non-refundable deposit of rupees 1 lakh at inception of the contract, and enters into a long-term financing agreement with G Limited. So for a remaining 95% of the agreed consideration, which it intends to pay primarily from the income derived from the food processing unit, as it lacks any other major source of income. So out of 20 lakh rupees, 5%, 1 lakh, it is given as the non-refundable deposit, and remaining 95%, which is 19 lakh rupees, that will be paid over the period of time, and it will be paid by as the P Limited gets income from their business. Okay, if they don't get, and it's a big question mark whether the remaining 19 lakhs can be paid. So the financing arrangement is provided on a non-recourse basis. So which means that non-recourse basis means that P Limited, if P Limited defaults, then G Limited can repossess the machinery but cannot seek further compensation from P Limited. So if at all, if G Limited could not, if P Limited could not make payment to G Limited, so G Limited can have access to the machinery, whatever they have, what are the conditions they have at that point in time, but no further compensation can be achieved or can be received from P Limited. So that's the meaning of this non-recourse. Okay. So even if the full value of the amount owed is not recovered from the machinery. Okay, so what are the machinery scrap value at that point in time only G Limited can receive. So the cost of the machinery of G Limited is 12 lakh rupees, and P Limited obtains the control of the machinery at contract inception. Okay. So now when should G Limited? So when should G Limited recognize the revenue? That's the question. Okay. So to answer this question, let's refer to some points under Ind AS 115. So as per Ind AS 115, all these below conditions should be satisfied in order to recognize the revenue. So one, parties should approve the contract and committed to perform the obligation. So I think in this case it is met. So there is a contract and parties agreed to a specific commitment and to perform the performance obligation. So we can say this is completed or satisfied. And second, each party's right and obligations can be identified. I think this can also be satisfied because we know what is the obligations of G and what is the obligations of P Limited. And payment terms are identified. So here also the payment term is defined and can be identified. And contract has commercial substance, that also we can say it is satisfied. In the last condition, it is probable that the entity will collect the consideration. So here it's a bit question mark because this cannot be satisfied because there is a big concern or no clarity whether P Limited can pay to G Limited, because solely depends upon how P Limited generate its income. Okay, so here customer's ability and intention to be considered. So in the given example, point number 5 is not met. So further, as per para 15 of Ind AS 115 states that if any of the above condition is not met, any consideration received should be classified as liability. So even the non-refundable deposit received should be classified as liability only. It cannot be taken to income. And accordingly, the 1 lakh received, even though it is non-refundable, to be categorized as liability until the conditions are satisfied. Okay. And there is one more para 16 under Ind AS 115 which states that the revenue can be recognized only when the performance obligation is satisfied or the contract is terminated. So if you have to recognize revenue of at least that 1 lakh rupee, so if the contract needs to be terminated, then only contractually it should be legally it should be terminated, then only the 1 lakh can be recognized as income. So till such time it should be disclosed as liability only. So in the given case, neither the performance obligation is complete in full nor the contract is terminated, hence no revenue will be recognized. Okay, then let's move on to the next example. So here entity I sells the piece of machinery to customer for 2 million payable in 90 days. And entity I is aware at contract inception that customer might not pay full contract price. Entity I estimates that the customer will pay at least 1.75 million against the 2 million, which is sufficient to cover the entity's cost, which is at 1.5 million, and which entity I is willing to accept because it wants to grow the presence in the market. So entity I has granted similar price consideration in comparable contracts. So entity I concludes that it is highly probable that it will collect 1.75 million only, and such amount is not constrained under the variable consideration guidance. So here what is the transaction price in this agreement? So here the transaction price, even though contractually it is 20 lakh rupees, 2 million. So we have to take only 1.75 million as consideration because you are in doubt whether to collect remaining 25 lakhs. And it's given that normally the price for this machinery is 1.75 million. So the transaction price will be fixed at 1.75 million. Okay, let's move on to the next example. Here on 1st January 2008, entity J enters into 1-year contract with the customer to deliver water treatment chemicals. So to deliver water treatment chemicals, so there is one performance obligation, and the contract stipulates that the price per contract will be adjusted retroactively once the customer reaches certain sales volume as defined below. So up to 1 million the price will be 100 per container, and above 1 million up to 3 million it will be reduced to 90 per container. Above 3 million the price will be 85 per container. Okay, volume is determined based on the sales during the calendar year. So there are no minimum purchase requirement. So even J estimates that the total sales volume for the year will be 2.8 million. Sorry, entity J estimates that the total sales volume for the year will be 2.8 million. So they have estimated under this category 2.8 million, which comes at rupees 90. Okay, and entity J sells 700,000 container to the customer during the first quarter ended 31st March 2008 for a consideration of rupees 100 per customer. Okay, so here the question is, how should J to determine the transaction price? So here the transaction price should be based on the estimate. So Ind AS 115 allows to recognize the revenue based on the best estimate. So here the best estimate is 2.8 million container, for which the price will be 90 per container. So the revenue should be recognized at 90 per container. So even though customer pays 100 per customer for the initial consignments, the remaining 10 rupees should be accounted as liability and not as revenue, and only revenue to be recognized at rupees 90 based on the best estimate. Okay, so let's go through the next example. Here entity K sells electric razors to retailer at rupees 50 per unit. A rebate coupon is included inside the electric razor package that can be redeemed at the end of the customer for rupees 10 per unit. So initial price is 50, but there is a kind of discount, and discount rate is 10 per unit. And entity K estimates that 20 to 25% of the eligible rebates will be redeemed based on its experience with similar program and rebate redemption rates available in the market for similar programs. And entity K concludes that the transaction price should incorporate an assumption of 25% rebate redemption, as this is the amount for which it is highly probable that the significant reversal of the cumulative revenue will not occur if estimate of the rebate change. So how should entity K determines the transaction price? So it's clear that your transaction price is 40 per unit, and the 25% of the customer will encash their discount. Okay, so which means 25% of 10 comes to 1.5 rupees. So you can estimate 2.5 rupees will be the discount, and remaining 47.5. So 50 minus 2.5 is 47.5 will be the transaction price, and the initial receipt of those 2.5 rupees will be categorized as liability, and revenue should be recognized at best estimate price of 47.5 per electric razor. Okay, we'll move on to the next example. Here a manufacturer enters into a contract to sell the goods to retailer for rupees 1000. So the manufacturer also offers a price protection whereby it will reimburse the retailer for any difference between the sale price and the lowest price offered to any customer during the following 6 months. Okay, so initially the price is fixed at 1,000 rupees, but they are willing to give a kind of discount based on the lowest price the retailer will sell to the end customer for the next 6 months. So this clause is consistent with the other price protection clause offered in the past, and the manufacturer believes that it has experience which is predictive for this contract, and management expect that it will offer a price decrease of 5% during the price protection period. So 5% is the normal discount, and management concludes that it is highly probable that a significant reversal of cumulative revenue will not occur if estimate change. So here how should manufacturer determine the transaction price? So this is also almost a similar example. So even though your initial price is 1,000 rupees, there is probable that you will give a 5% discount. So your price will be only 950. Transaction price will be only 950, and the initial consideration of 50 needs to be classified as liability. Okay, we'll move on to the next example. Here, electronic manufacturer M sells 1,000 televisions to a retailer for rupees 50 lakh, which is 5,000 per television. And M provides price protection to R by agreeing to reimburse R for the difference between the price and the lowest price that it offers for the television during the following 6 months. So based on M's extensive experience with similar engagement, it estimates the following outcomes. So the rebate will be 0, which have 70% chance, and rebate will be 500 rupees, which has 20% chance, and rebate will be 1,000, which has only 10% chance. So how to determine the transaction price in this case? So here the probability is given 70, 20 and 10. So 70 into 0, that is 0%, 0 rupee, and 20% of 500, that's 100 rupees, and 10% of 1,000, that's another 100 rupees. So in total 200 rupees will be the discount. So from 5,000 minus 200, 4,800 will be your transaction price. $4,800 is the transaction price. Okay, let's move on to the next example. Here, construction company C enters into a contract with customer E to build an asset. So depending on asset, when the asset is completed, C will receive either 110,000 or 130,000. So 130,000, if the project is completed on time, it's 90% probability, and if project is delayed, only 110,000, it's only 10% probability. So here we cannot apply the weighted average because you can have either one outcome, not all the outcome. So either you complete on time or you are getting delayed. Since completion on time have a higher probability, more than 50%, then we can conclude 130,000 will be the transaction price. Then let's move on to next example. So here franchisor Y Limited licenses the right to operate a store in a specified location to franchisee F. So you have franchisor Y and franchisee F. The store bears Y Limited's trade name, and F Limited will have a right to sell Y Limited's product for 10 years. And F pays an upfront fixed fee. The franchisee contract also requires Y Limited to maintain brand throughout the product improvement and marketing campaign, etc. So determine the nature of the license. So here the license provider provides F access to IP, so intellectual property is getting provided as it exits at any point in time in the license period. Okay, so therefore the license upfront fee should be recognized as revenue over the franchisee period of 10 years. Okay, then I have tried to give one one homework here. So please go through. I mean, this is the sum we had in one of the CA final exam. So please go through and try to answer yourself. Okay, with that, let's conclude. If you need any further assistance, please comment.